to financialspreadbet.com. My name is Stu Wisson. In this article, we're going to be talking about the commodity market. Now, let's assume you're biting down onto a lovely bar of chocolate. Nice, isn't it? Now, chances are that the company that makes that chocolate has made millions of bars of chocolate all over the world. A good example of that is Cadbury. But have you ever thought how they secure the price for the cocoa that is used to make that chocolate? Now, many food products contain soya too. What about the cotton that makes the shirt or blouse that you're wearing, or the orange juice that you're drinking in the morning? How do large manufacturers maintain price future stability in products that they make? Now, the answer is in the commodities market. The commodities market covers a large and developing list of physical products, foods, electricity, metals, oils, gas, and so on. Initially, the commodity markets were strictly for agricultural purposes. This sprung from the development that ensued over the world in the 19th century, with transportation becoming easier and farming on larger scale allowed for more wholesale pricing of common agricultural items such as grains, pigs, cattle, and so on. A means to trade this began, which was the foundation of the commodity market that we have today. However, the modern commodity market contains a greater array of products, way beyond that of just agriculturally produced items. The commodity market, much like all the other financial markets that I have been discussing, does have a good degree of duality. By that I mean it serves its true aim by providing a means for companies to buy contracts to purchase or sell commodity items at a future set contract price. However, as with the dawn of computers and the rise of the ever-greedy financial markets, there has been an increase in the amount of products that can be traded that are derivatives of this same market. Remember that a derivative is basically a product created that has no intrinsic value of its own, other than that of the outcome of the contract closing event of being true or not, and to what degree, based on the underlying product. In fact, apart from stock trading, which has no ability to short the market, in other words, make money when the market is going down, when I was young, my father invested in the financial markets. All there was the stock market and the futures market. The futures market back then was focused on commodity prices, the underlying. But this same market is what companies use to secure the sale of purchase of commodity items. Now, I remember looking around at around 16 years old at the promotional material my father received from his broker about the futures options market. It took me a long time to understand how it worked. I simply couldn't get my head around that you could own something but never take delivery of it. You could trade it but only have to pay a fraction of the amount you are buying or selling, and if the market moved in your favor, you would make money. In many ways, many people, even today, do not understand truly how the markets work, and that most trading these days are based on derivatives. Very few actually take delivery of the item they have a contract for. Good job, really, as when I did trade futures and options, option to buy is a call or option to sell is a put. I had little experience and did so not really knowing what I was doing. In fact, if truth be known, I was petrified of having a contract go to expiry, as I imagined very early on when I first started that I would end up with several tons of pork belly meat on my doorstep. Needless to say, my moment trading these was very fleeting till I found financial spread betting. Now let's take a look at the commodities trading methods. We have spot trading. Now, spot trading allows for delivery of the commodity to be taken immediately or soon after the transaction has taken place. In other words, on the spot. The commodity market does have a lot of standards, so inspection is never required because all products that are delivered must meet certain standards. If, however, inspection is required, then the buyer or seller cannot market on the commodity markets and must use the basic wholesale market. Now, the reason spot trading exists basically allows for manufacturer to purchase additional product for immediate use. Say, for instance, if demand of a certain item that they are manufacturing is outstripping their supply, then the company in question will use spot trading to purchase more at the current market price. We also have forward contracts. This is a contract between a buyer and a seller where the price of the commodity item is agreed on the day the contract was created, with a fulfillment date in the future. Now, standards vary and samples of the product are usually taken to agree a price and future delivery. Next, we have futures contracts, the most common. Now, this seems almost identical in terms of a forward contract in that there is a contract between the buyer and a seller to agree the sale or purchase of a commodity at a price fixed today with a delivery in the future. However, there is a key difference. Forward contracts are an agreement to deliver, and the amounts of commodity are agreed in the contract, and the contract is always fulfilled. In other words, the 100 tons of belly pork is actually delivered. Whereas with futures contracts, the amount, grade, standards, and so on are on a preset by market standards and delivery. Most futures contracts are never fulfilled. It is simply the trading of these contracts that allows for speculation of the commodity markets. However, you can, of course, take the option to purchase the contract to fruition. Hedging in the commodity markets allows for groups of suppliers to form a cooperative to ensure against poor yields of their commodity through the use of futures contracts in the same commodity in which they supply, therefore allowing them to hedge any risk of a poor yield through the ability to profit from that of taking a speculative trade in the futures market. If the supply of a commodity they produce is in short supply, the futures market for that commodity goes up in value, and therefore the cooperative can still profit with a poor yield.